Colin, you are looking for a really, really bad number next Friday. Why and what?
Well, I just think, again, with not a lot of support, that things are getting better. I think that the forecast will have overshot where we'll be. So at about 85,000, I would be much more inclined to think it's going to be closer to zero than 85,000. And also, importantly, I want to see the revisions because that would feed into my thought process that things look better than people think.
Where would you be looking elsewhere outside the headline number to see that kind of stuff?
To see that things look not as good?
Yeah.
It would be the revisions coming down.
Just on the headline number, though?
Yep.
Not in hours worked, nowhere else in the payrolls report?
That stuff to me is messier. I want to look at the more specifics of the headline.
Kathy?
We're looking for slightly under the consensus, closer to 70 or 75 than the 85. But it will be a messy report because of the GM strike and several other factors. So even in the hours worked and average hourly earnings, it may be kind of hard to parse through exactly what's happening. But it's slowing down. I mean, employment growth is slowing down. We know that.
Jim?
Yeah, I think obviously because of manufacturing, some of the things in the autos, and I mean, we've seen it through a lot of the data, it's going to be a weak number. That being said, I would somewhat look through it, and I do think that average worked, and I mean, the consumer has been a positive story in this whole thing, so although I think jobs are slowing down, I still think the consumption and the consumer is still in a good place.
We've got to get to a Fed decision first next Wednesday as well, Jim. 75 basis points is what most people considered a mid-cycle adjustment to be. If we get another cut this coming Wednesday, that's 75. How does the Fed communicate that they may well be done here without upsetting this market?
Well, I think they'll cut, and I don't necessarily think they'll say they'll be done. I think the Fed has continued to move towards the language of being more data dependent. And we all can look into the next 6 months. There's a lot of different things going on between trade uncertainty, the election, that can create a variety of different outcomes. So I think they'll leave a lot of optionality open, but I think that language will be important on how the markets will trade in the short term.
Kathy?
Yeah, I would agree. I think they'll try to go on pause, but I don't know that they'll actually communicate that. I think they'll try to communicate that, okay, we're done for now, and we're just going to wait and see. But I think their inclination is to try to stop after this if they can.
What do you think, Colin?
Yeah, I think they've put themselves in a position where they have to lead the market into thinking that they're still data dependent, which I don't really like, because I'd be happier with them if they were actually forecasting or entrusting their forecasts. Data dependent doesn't tell me a lot, and when they talk after every meeting, that doesn't help me a lot either. So the bottom line is, I think they've painted themselves in a corner, and they're going to have to position it that, no, we're not really done or pausing necessarily. We're not sure. Let's go from here.
They're data dependent. This is a question that's come up so many times on this program over the last few years. Which data are they dependent on?
I think it's inflation, and I think it's growth. But I also think that they now take into consideration global growth versus just U.S. domestic.
You've got
growth.
a decent handle on that, Kathy.
No, and I would say I don't think anybody really knows all of the sum of all that they're looking at. I think they talk about inflation being below their target, but many measures of inflation that the Fed produces are well above 2% already. So it's hard to know, is it just core PCE that matters, or is it other data? They talk about the employment situation, and some still believe in the Phillips curve. Some don't believe in the Phillips curve. They talk about the global headwinds. So we know those, headwinds will be stronger sometimes and weaker at other times. So do we really know exactly what they're looking at? I don't think so.
Reaction functions evolve. That's, I guess, the nature of central banking. But Jim, do you understand the reaction function currently at this Federal Reserve?
Yeah, obviously, I think there's still room and capacity just because the aggregate debt in the system is still a deflationary aspect of that. But I think what is also this Fed is looking at is labor, right? And I think some of the inflationary data, if it is labor income that is increasing, and that can hold up aggregate demand, I think this Fed will be willing to run with inflationary data that's higher. They still haven't been able to get it there, right? And so I think, for the last 10 years, corporate profit margins have benefited. If the next 10 years you see some labor inflation at the expense of profit margins, but aggregate demand holds, I think that's still a pretty positive story from a Fed perspective.